have to view hedge funds as a prisoner's dilemma, and where as long as everybody cooperates, everybody gets something. But every individual has the ability to take down the house of cards. So you have investors who are basically, if you think about a corporate structure, they're the equity investor in the hedge fund. So the hedge fund goes out and buys a bunch of assets. That's the asset side of the balance sheet. You've got the equity investors on the balance sheet, and then you've got the debt providers on the balance sheet. And the prime brokers are the debt providers, and they have a senior claim on the assets of the firm. The hedge fund management also are kind of somewhere in between. They have a lot more information about what's going on inside the fund, but they also have a right to redeem. They can get their money out if they want to before you. They can invoke the gate on the fund, which stops you from getting your money out as an equity investor. So these are the controls on the claims of the fund. And importantly, the prime broker, being the debt provider, has the right to increase margin, call for bigger down payment on the position on the portfolio, have the right to cancel the financing, saying I'm taking all my debt back tomorrow, tonight, give me the money, which forces liquidation of the portfolio. The right to refuse trades, to say, oh, you want financing on IBM? I know I was going to do it yesterday, but I'm not going to do it today. And that can really be disruptive to a trading strategy. And you have a right, you do get an income stream from taking that risk, which is similar to a bondholder, and that you charge interest on the financing that you give to the fund, and that comes out of the returns that the fund generates. But you don't have that equity participation. So you've got as a prime broker, you've got a very limited upside and indefinite, you're a total downside. The value of your debt that you've lent, the hedge fund can blow up and you can get nothing back. Whereas if you're an equity investor, you've got a much higher upside, and yes, your equity investment can fall to zero. And the hedge fund manager has probably much more upside and a more limited downside because they've really got less invested in the fund than the typical investor. So as a prime broker, we lent to hedge funds. Hedge funds clients wanted low and fixed margin levels in order to get a large amount of stable leverage. We wanted to get paid for the risk of lending to them, and we didn't want to lose principal. Who we lent to, how much we lent, how much margin was required, when we stopped lending were decisions of my team. And our objective was to maximize the commercial terms to attract hedge funds. Hedge funds are big traders. We get a lot of ticket fees. We get a lot of interest income from the money we lent to them. But we also want to minimize the frequency with which hedge funds blow up and go down with our money. We had both commercial pressure and we had risk management pressure. So we had to take risks, but we had to do it intelligently. So the things we think about in terms of how hedge funds blow up, they can overdose on leverage, which is and underappreciate basis risks, which is my short diagnosis of LTCM. They can be overly concentrated or take a greater portion of the portfolio in liquid positions, which is the case of Amaranth, concentrated in natural gas. Eagle Global had overconcentration in what turned out to be illiquid positions. There can be fraud, which is Bayou, Wood River, and Madoff. So protecting ourselves against these risks were part of what we did. We used quantitative and qualitative methods to do it. So just a quick thing about brokerage and margin financing. How much margin we charged and when we lent money was a function of the quality of the collateral that we would get in exchange for that. And there was always securities. Those securities were given to us as a portfolio. So if a manager came to us and he said, I'm an equity market neutral, here's my portfolio that I want, how much money will you lend to me against it? We have to analyze exactly how neutral is this portfolio. Is it balanced in terms of industries? Is it balanced in terms of countries? Is it balanced in terms of sectors? Is it balanced in terms of currencies? Is it balanced gross in terms of overall market sensitivity? And then stress test it. When can these balances come out of whack? How wide can they go when these bases start to explode? And when we see that, we got a good handling of that, then we'll lend you everything but that. So that was really, our last view as to, in the worst case, how much money could we get from this collateral in a bad market. But then you have prime brokers who, are smart, or hedge funds that are very smart. They'll trade the prime brokers off against each other. You really want their business. They're a big hedge fund. They trade a lot. That can be a lot of income to your bank. They want the most aggressive and stable margin conditions. So they'll ask for a 180-day lockup where you agree the rules by which you'll calculate margin, but you will not, and you won't change them for 180 days or 360 days. You will also negotiate, lower financing costs, lower rates of interest on the either. Typically, it's on the borrow side, which is one of the attractions of bringing people to a prime broker, is the ability to get you into hard-to-borrow stocks. But how much does it cost you to stay in that borrow really impacts the effectiveness of an equity long-short, how the returns of an equity long-short fund. And then, so there's competition. It's a competitive game. And over time, when markets are stable, those terms get negotiated to be very much in favor of the hedge funds. So, I'm going to talk a little bit about, how we did things up until 2007. A lot of the view was, well, the hedge fund managers would say, well, you can't ask for more collateral than the value at risk of my fund, of my portfolio. And we'd say, well, yes, we can, because we know that there are periods where, where tail events can occur. But they would always start with the position of, lend to me everything but the value at risk of my fund, of my positions. And look back at, price history up until 2007, or I'll pay you the margin that would be necessary to insulate you against Black Monday, for example, in 1997, or 1987. So that's really a period of measurable risk. If you quantified your margins based on this period, you would come up with a much lower margin, and you've got to be, as a risk manager, aware about when there's limitations to what you can measure. There's a period of time when God's away on business and markets go crazy. And you've got to be able to protect yourself, for that. So stress testing is very important, and we set our margins, based on stress testing. But then along comes, 2008. This is a chart which just shows you, basically, it's evidence of regime shift. Right? We showed earlier the period up to 1987, very measurable and controlled market volatility. And then after that, you had 1987, which was remarkable, but then you had 2008, which is even more remarkable. So these are the days in which large moves in the S&P occurred in their frequency. So you see that not only was the magnitude of the changes in 2008 larger, but the frequency with which they occurred more frequent.